Hey, what's up, everybody? Welcome back to Investing Sucks. So, in this video, I'm going to be talking about my most recent investment that I just opened up a position in. So, this video is going to be like the What's on My Watch List series that I've been doing on this channel lately, except for this one, I've actually already bought the company, and it's not just one that I'm simply watching. Now, I should probably start this off by saying the obligatory thing that all finance YouTubers have to say when they talk about one of their investments, which is this is not financial advice. Do not make any investing decisions based on what some guy on the internet is saying. And I do think that is important to say here because I really don't want people to just start following me in what I'm doing because everyone's financial goals, everyone's risk tolerance is going to be different. So what works for me probably won't also work for you. And this investment that we're going to talk about is a very risky one. I mean, really, any significant investment in an individual company is going to be risky, but this one in particular is risky because we're talking about a very small company with a very uncertain future. And there is a chance that I could lose money here. And we're going to get into all that later. But what I want to do in this video is first talk about who this company is, what they do, how they make money, why I think they're actually undervalued right now, and then actually show you my valuation with all the assumptions that I made and basically explain, my process behind how I found this company and how I ended up valuing them. So the company we're looking at, it's a US company and it's a company called Thrive Holdings, or the ticker symbol is THRY. And by the way, if you're wondering what this website is that I'm using here, so if you're new to my channel, it's a website called tickernomics.com. It's one that I created and it's currently free to use. I will leave a link in the description of this video if you would like to check it out and use it for yourself. But this is a very unique company in that they're at a crossroads in their company's history where they could either end up being super successful or they could be a total dud. And as we can see here, they're a part of the communication services sector and a part of the internet content and information industry. But really, they're a part of the software industry, which for me is good because I've been looking to get some exposure into an enterprise software business for quite a while now. I've been really just waiting for the right opportunity. So, this company, they break out their business into four main segments on their financial statements, but really they have two main segments and two totally separate businesses that management operates them as two completely different businesses, but they are connected in a pretty unique way. And I think the fact that they have these two very different businesses that are both have different dynamics going on is why their industry classification here is a little weird. And this kind of ties into one of the many reasons why I think this company might be undervalued, just because there is a chance for it to be somewhat misunderstood in that their industry classification isn't entirely accurate. So, like I said, I think they're a part of the software industry. I'll talk about their business segments now and also how they're connected. So, there is Thrive US Marketing Services. There's also, if we scroll down here and just go through them, Thrive US SaaS. So, SaaS is obviously software as a service. Then there is Thrive International Marketing Services and Thrive International SaaS. So what the marketing services segment is, if we go up here, so this segment here, marketing services, it's really just the yellow pages. And yes, I literally mean those giant books with local phone numbers that you used to look up numbers in. Now they also have internet yellow pages, which are a series of web domains that they own and operate, and then some smaller services like search engine marketing, search engine optimization, and they make money by selling ad space in their print yellow pages and their internet yellow pages. And as of 2022, this accounts for 82% of their business. So it is the lion's share of their business. Now, this business is in material decline. As anyone who knows anything about, what's going on in the world can probably guess that a Yellow Pages business is in material decline. And this is no secret, right? They state this openly. They state that their primary demographic is people 55 and older, typically homeowners who have a higher propensity to spend money with the advertisers that have advertising, on their web domains and also in their print yellow pages. So it's not a question of whether or not the business is declining because we know it is, but how much will it decline and how fast will that decline take place? So management's current guidance is it's going to decline about 20% per year in terms of revenue, with profitability staying roughly the same. They say that they have a EBITDA margin of around 40%. They expect that to continue into the future. And they are offsetting that revenue decline by opportunistically buying some smaller yellow pages businesses and then basically just riding them out, whatever earnings and cash flow is left in them. So that's the marketing service segment. That is the one that's in material decline. Now let's talk about the SaaS business. This one is very different in that it's a very uncertain business with an uncertain future, but it is growing fast. So they have the SaaS business. It's a rather new invention as the software for it was only developed about 5 years ago, and it really hasn't found its full footing until the past 2 or so years. And they call it the Thrive platform. And what it is, it's a cloud-based business management application designed for small and medium-sized businesses. So we're talking about businesses, typically 10 to 50 employees, businesses in kind of service-based businesses. So think plumbing, HVAC, some legal firms, some accounting firms, maybe even some health and wellness like doctors' offices, spas, it's that kind of thing. And the platform just does basic things like invoicing, taking payments, customer relationship management. It helps with marketing, and they have a whole bunch of other things that they do. So it's really just a general business management software, and it's still being developed. They're still adding new things. They recently added the ability to take payments, which is something that's growing really fast, and they now earn a cut of that. And if we go to their most recent investor day here, so this is their Q4 2022 presentation, I want to discuss that one unique connecting factor that these two businesses have, because I did mention that before. It's not just the fact that there's these two different businesses and they're misunderstood because there's like this hidden SaaS business that no one knows about. I mean, people know about the business, but there's the unique connecting factor, which is how they're using the relationships that they built up from this legacy marketing business to get clients for their software business. And they also use the stable and very predictable cash flows of the marketing services business to self-fund their growing software business. So why is this such a big advantage for them, versus other software companies out there? So the company stated in a recent earnings call that about a third of their clients for the SaaS business come from the marketing services segment, and about another third come from referrals, and then the other third would be from their marketing efforts. So because of this, their customer acquisition cost is extremely low. And if you're wondering, well, why does that matter? Because if you look at literally any other SaaS company that's out there that is in the growing phase, they're spending tons of money on sales and marketing, tons of money on research and development. They're running massive losses and they have to raise money in order to keep the business alive. And, just to prove this point, so I'm not just saying that and not providing some any actual substance, we'll look at some income statements of just a few software companies. So I picked two. I picked HubSpot here. So this is HubSpot's 2022 full year income statement. HubSpot would be probably the most relevant competitor to Thrive that you can buy on the stock market, in that they offer a similar product, but they're generally targeting higher value clients. So companies with, say, 100 to 1,000 employees, or maybe even more, whereas Thrive is really in the smaller, like service-based businesses that, again, they've already built up a relationship with through their marketing services segment, like the Yellow Pages and whatnot. So let's look at their income statement. I'll zoom in a bit here so you can see it a bit better. So they have a bit gross profit here, 1.4 billion in 2022. Research and development about 450 million, and then sales and marketing just under 900 million, right? So all that, and they're running a loss from operations of about $100 million. So these are massive expenses, right? Now let's take a look at another one. There's a company called Twilio. Now, Twilio isn't really a competitor per se of Thrive, but I wanted to just pick another company. And by the way, I'm not hand selecting these. You can do this with any growing SaaS company out there. Look at CrowdStrike, look at Snowflake. I mean, it'll be a similar story. So we can see 1.8 billion in gross profit, research and development about 1.1 billion, sales and marketing about 1.25 billion. All of this to run a loss from operations of 1.2 billion. So they're spending a lot of money. Now let's compare this to Thrive. So Thrive is obviously going to be much smaller. This is Thrive's full year 2022 income statement. Gross profit 780 million, sales and marketing about 362 million. And they don't even have a separate line for research and development. It's not that they're not doing it, it's just that it's probably grouped into one of these other line items here. And overall, I mean, they're running a profit, right? Operating income of this. Now, their SaaS business is currently running a very small loss. So it should be profitable by next year, but currently it is running a very small loss. And if we look at the actual income statement, a very large expense here is this impairment charges of just over 100 million, which it relates to goodwill impairment. So they have goodwill recognized because, like I said before, they're buying other marketing services businesses and then just riding them out for whatever cash flow is left in them. So goodwill, they're going to have to write off some of the goodwill because those businesses probably they're in material decline and the goodwill isn't really worth as much. So for accounting reasons, you have to write it off. But it's basically nothing. I mean, it's a large expense, but it's no secret as to why it's happening. And it's not really a concern because it's happening for a reason that any sensible investor in this company is already well aware of. So the idea behind, the whole SaaS business model is from what we're seeing here, and again, you can do this with any other SaaS company that's out there, is you invest heavily in things like research and development, sales and marketing. You do that now to lock in your customers by being a mission critical application, adding all these new features, develop the product so that it becomes the industry standard. And then once you have a large and sticky customer base, you cut back on the marketing investments and basically just earn loads of cash flow and then return it to shareholders. So this is like the dream of any software company that's out there. And this means in the early days, those businesses are going to lose money and they're going to have to raise financing, which in today's world, that's pretty tough to do, right? I mean, especially if you're a Silicon Valley based company, raising financing with the whole SVB collapse that happened about a month ago. It's going to be difficult, right? And interest rates are higher. People aren't as willing to take risks with their money as they were 18 months ago. So raising financing is going to be more difficult. Valuations are going to be lower. It's not impossible, but it's more difficult. But Thrive doesn't have to go through this, right? Because they're in this unique position where they have this other legacy business they're scaling down and they can draw customers from it. So the fact that they're in this very unique position for them is a big advantage. Okay, so that's a little bit of background on the business. Let's next talk about why it's cheap or why I think this company is undervalued. And I've got some metrics summarized in Excel here, which I think tell a pretty compelling story about this company. And the reason is, or reason number one is any quick scan of this company's recent financial performance will make any sensible investor immediately look away, whether you're looking at them because you're interested in the software business or the marketing services business. Because what you see right off the bat is a declining Yellow Pages business that has no hope of ever turning around, and an unproven software business that had some real struggles when it was initially launched, and there's no certainty it will ever be successful. So let's look at some of the metrics here. We can start by just looking at revenue by segment. So they have 4 segments, but I split them into the 2 ones here, which is the software one and the marketing services one. So the marketing services one in 2019, about 1.3 billion, and it's now shrunk to under 1 billion. So we know this is going to continue, right? This is no question. Again, management guidance is about 20% a year, but it could be more or it could be less than that. The software business had revenue of 128 million in 2019, and it's grown to 260 million in 2022. But it didn't actually grow that much from 19 into 20, but then grew substantially from 21 into 22. So that's a little interesting. Let's double click into that and learn a bit more. Now, they also provide this metric here, which is KPIs such as their total clients. So these are in thousands here. We can see their marketing clients. Predictably, these are decreasing. Again, this business is in decline. But if we look at their SaaS clients, they went from 54,000 in 2018 to 52,000 in 2022. So that's going to be a huge red flag for any person that is looking at software companies, because any software company that cannot consistently grow their customer base is doomed for failure, because you're going to have churn in your customer base anyways. You need it to be growing in order to stay afloat. But it decreased kind of, into 2020 here, and then it increased in the following year. So this is kind of interesting. It is concerning to see it go down, but it's interesting to know why it decreased so much and then increased so much. So the next part of the story is we can look at this, another metric they disclose, which is ARPU, monthly ARPU, which is average revenue per user. So again, for the marketing services business, we're going to see this decline. This just relates to decreased spend in this business overall. But in the SaaS business, it increased substantially. It went from $201 per month in 2018 to nearly $400, so almost doubling in 2022. So that kind of makes you think, okay, well, that explains why their revenue increased despite their customers going down. And what we learn about this company, by looking at these metrics, is that a few years ago, they drastically increased the cost of their software platform because they wanted to focus on higher value customers. And also probably because they thought that they were charging too little for the platform and they could get more out of it. So this predictably led to the loss of some customers, right? The lower value customers, they said, We're not happy that you're raising your prices, so we're going to leave. But remember, they're still growing, right? They're still gaining new customers, and all their new customers are going to be higher value customers that are paying more for their business, right? And we can see this reflected in the average revenue per user as it's, consistently increased. But overall, we can see pretty much flat clients and revenue growth that was flat initially, but then did end up growing. So what my prediction is here is that this change in their pricing strategy, because again, the software's still in the early phases, they're still trying to figure it out. It's basically masking the underlying growth potential of this company. And to illustrate this dynamic, I put together this chart here, which this kind of looks at over time. This blue line here would be their total revenue, which is obviously in thousands of dollars here. And then the orange line is their low value customers, and then the gray line is their high value customers. So we can see, the two offsetting forces, lower value customers leaving. And by the way, these aren't exact numbers here. These are just, kind of sensible estimates I put together on what is, likely the split between low and high value customers. So low value customers are leaving, high value customers are coming into the platform. And because more higher value customers have been joining the platform in recent years, that's why we're starting to see this revenue growth and ultimately, this much higher average revenue per user. So as this continues, you're going to continue to see higher revenue growth that is higher, likely higher than what it's been historically because new customers are adding or paying a lot more. And all the lower value customers are, have left the platform at this point. So that's one of the reasons. Again, it's not something you're going to find just by doing a basic scan of a company. You have to actually double click and learn a bit about the business, what the business does and their history in order to uncover that. So another just general thing I want to state is the growth opportunity for SaaS, right? Especially, the software that they provide, and they specifically state that they have what they believe is about 4 million potential customers, right? So the market for their software is huge. There's lots of potential businesses out there they can sell to, and it's not a question of, they just provide this very niche service that is like only for law firms or something like that. They have plenty of customers out there that they already have some established relationships with through their marketing service segment. So from this, we understand, okay, yes, the market opportunity exists, but can they actually capitalize on that, right? Because lots of software companies will talk about how big the total addressable market is, how many customers are out there, which is great, but can you actually get them? And we did talk before about how they're using their existing relationships from the marketing business to win clients in the SaaS business. And that will still be true for a number of years, but what happens when that runs out, right? Can they still win customers without the help of their marketing services segment? And this, I can only speculate, right? I did do some research, like making sure the platform has good reviews on, the websites out there that rate enterprise software by the people that actually use it. And they're still coming out with new features and new add-ons, talking to customers about what they want, improving the platform. And we do know that a third of their customers come from referrals, and a third of their customers come from their marketing efforts, presumably already. But it's ultimately the biggest risk you face with this company because you can make assumptions about the future. You can look at clues that they've disclosed in their, press releases and financial statements about, what the future will be, but there's just no way of knowing until it actually happens. And personally, this is why I think this company could be a great investment, right? Especially, if you're the type of value investor, you're looking at companies that are at a crossroads because their future is uncertain. If their future was very predictable and very certain, there'd be no opportunity to, for the company to be mispriced and there to be an opportunity to earn some good returns there. So we do know it's a massive market. They could offer their service to any small business out there, which there are a lot of. But one other metric I want to point out, which again would probably be a reason why this company might be cheap, especially to software investors specifically, is this metric called net dollar retention. So this is another common metric used by SaaS companies, and it measures the change in spending by existing customers. So if this is above 100%, that means your average existing customers are spending more with you on a year-over-year basis. But below 100% means you're probably not retaining your customers. So we want to see this above 100%. And I'll zoom in a bit here. Thrive is currently at 91%. And then I have some comparables here as well. Like we can look at HubSpot, they're above 100%. Twilio, they're above 100%. And then Snowflake, which it's a totally different business. They are a software business though. they really have, the gold standard of net dollar retention at 168%. That's more a product of, their specific business model, but the main thing I want to point out here is Thrive being below 100%. So that is concerning, right? That's going to turn away a lot of SaaS investors, but also, I think the reason why is because of this change in pricing strategy, right? Because they're having customers leave the platform that aren't okay with with the higher spending, and the platform is still relatively new, right? They are developing new features. So ideally, looking into the future, you're going to want to see this get above 100%, preferably within the next 1 to 2 years. If this doesn't get above 100%, then that's going to be a clue that, okay, maybe my initial thesis in this company was wrong and I need to revise it. But at least for now, I'm giving them the benefit of the doubt, and I'm saying it's just low now because of their pricing strategy, but I do want to see it higher in the future. Okay, so the last thing I want to discuss in this video is my actual valuation of this company. Now, to value this company, I used a 5-year discounted cash flow model, which for this company is appropriate because they are generating cash flow. They're cash flow positive, so we can value them using this method. And also, the SaaS business should ideally be profitable in the coming years. So I'm not gonna explain every single intricacy of this model. I'm just gonna focus on the key assumptions. And if you have a specific question about something that I've done in this model and you want to understand my rationale, then just drop a comment in the comment section and I can answer it. So I've split them into two businesses. Here is the marketing services business. Here is the SaaS business. And really, I'm just trying to project EBITDA, because then once I have EBITDA, I can take their combined EBITDA, take out taxes, take out any capex, working capital investments, add back the share-based compensation to get to unlevered free cash flow and work from there. So it's a bit of a technical model. So I'll go over the assumptions here. So for the marketing services business, I'm assuming a 33% EBITDA margin going forward, which to calculate that, I just basically looked at some historical data about um, what their EBITDA margins were. They reported their adjusted EBITDA margins, so I had to kind of, take out all the adjustments to determine what their actual EBITDA margin is. So I just got, a close estimate, and I got 33%, and kind of went a little bit more on the conservative side, just to have some safety in the financial model. So 33% EBITDA margin, 35% revenue decline next year, which is in line with their guidance, and then 25% thereafter. Now, I said before, management guided about 20% decline per year. So I am going a little bit more conservative versus what management is predicting, which I think that makes sense personally, because, management, they have their goals, but they're not always going to be right. And then basically for the terminal, so after 2028, 5 years in the future, I'm assuming that this marketing services business can be bought for 1x EBITDA, which is obviously an extremely low multiple, but it makes sense for a business that we know is declining. Now, for the SaaS business, I assumed their revenue next year will be in line with guidance. So 19% growth and then 25% growth thereafter. Now, they did state in their recent investor day that they have a long-term goal for revenue of hitting 1 billion in 5 years. So I'm assuming they're going to be less than that, about 24, 23% under that target. So again, I'm taking, management's guidance because, you know, they can offer their predictions all they want, but ultimately you have to take it with a grain of salt and just being a little bit more conservative. And I do believe that these revenue targets are achievable for the reasons we discussed before about how some of their revenue growth may be being masked. But obviously, they have to actually achieve this. So I'm definitely going to be monitoring future earnings releases to making sure that they're on track for this. Because if they aren't, then it means I was wrong and I need to get out of this investment. And then I'm also assuming a 5% EBITDA margin next year. So they turn a little bit of profit in terms of EBITDA. And then that increases gradually into the future years and gets to about 20% in 2028. So 5, 8, 10, 15, 15, 20. These are kind of just estimates, but it should follow a similar pattern because, as a SaaS business, as they scale up their revenue, they achieve economies of scale. They don't have to invest a proportionate amount into all their expenses like SG&A, so they can become more profitable. So then we get, the EBITDA for the SaaS business. And then in the terminal year, I'm assuming they're selling at a 15x EV EBITDA terminal multiple. So That is, I think that's quite conservative. I mean, pretty much any software business out there is probably going to be higher than that, any growing software business specifically. So I think that's a conservative assumption there. And then so we have the combined EBITDA. I won't go over all this part here, but essentially we just get to projecting what their present values of the cash flows are, so we can get to an enterprise value. We then subtract out the debt and capital leases that they have, which they actually have a surprisingly high amount of debt. And from this, we can almost assume that their debt is basically can be paid off by the marketing services business, which I think that's a fair assumption because the marketing services business is roughly equal to about their debt. So those two kind of cancel out. And then we also have to deduct, they do have a frozen pension plan for some of their employees. So that's a liability. It's an underfunded pension plan. So we have to deduct that out net of tax. So I just went with the most recent valuation of it here. We add back any cash and short-term investments they have to get an equity value. And then we divide by their shares outstanding and we get an estimated intrinsic value per share. So after all that math, $45. And their current price per share is $23. So they're currently valued about 50% of my estimate of their intrinsic value. So that I think is good enough to open a position, right? That's a good margin of safety. There's plenty of room for my assumptions to be incorrect in there, and they don't necessarily have to hit these targets in order for me to earn a good return on my investment. So I feel somewhat safe, even though obviously there is risk built into this company. And then, for proof that I actually bought them, I just included a screenshot here. So that's mainly it. That's pretty much my thesis in this company. It's probably going to end up being a pretty long video, so congratulations if you made it this far. This for me, like my plan for this is not a long-term hold. This is not a hold for 10 plus years kind of company. This is ideally a 2, 3, 4 year hold, waiting for some results to come out that are better than people expected. Wait for people to realize, the true growth potential of this company. So investor sentiment then shifts and this company, their stock price starts to converge with our expected intrinsic value. So if this were to go up to, say, $40 per share and my estimate of the intrinsic value doesn't change, then I would sell it in that case, which would obviously be a pretty good return if that were to happen in 2 to 4 years. So that pretty much does it for this video, guys. So I hope you did find this useful. If you did, please leave a like. And if you're new to my channel, please consider subscribing. I've got lots of content like this planned in the future. And I'll see you guys in the next video.